trace the secant intersects the circle of 2. A center angle. So we're going to do the Chapter 9 test review. So I'm going to start with part doing FICA because I know I missed that in the last that quiz review. So I'm going to go ahead and go over that. So it says in 1990, the maximum income, remember Social Security has a maximum, was $106,800. FICA tax rate was 6.2%. Okay, so that would be if we're just doing Social Security. And on some paychecks, I guess they do actually have that. So what's the maximum? So we're going to use the maximum amount, everybody. So the $106,800, okay, times 0.62% is the decimal. Everybody remember, drop the percent sign, and we go to the left, add the decimal and the 0. Sorry, I'm trying to do this over here. And so it's going to be 0.062, and that would be the maximum amount that people would pay in 2009. Okay. Okay, so we would get $6,621.60. That would be the maximum in 2009. Okay, so let's look at Bill. He had 2 jobs. So one that paid him $177,090, and the other paid him $31,280. So they both took out Social Security. So if we add those together, that would be over the $106,800. So we need to add those 2 together. So we're going to add those 2 together first. And then we'll multiply that by the Social Security percentage as a decimal. So go ahead and put those in your calculator. Make sure to use the parentheses. So that adds them together first before you multiply. Okay. So we get $6,718.94. So Bill definitely paid over the maximum. So now we're going to subtract it from the maximum amount in 2009. Okay, and that's going to give us how much Bill overpaid in Social Security. So he overpaid $97.34. Okay, so this one, so we're doing a little bit of review. So in 1990, to earn 1 credit was $520. In tax year 1990, she earned $187 bi-weekly. Everybody remember, bi-weekly is going to be 26. Okay, so we're going to multiply that. So 187 times 26 is going to give us her earnings. So she earned $4,862. Now we're going to divide that by 520. Okay, and that'll give us the number of credits. Okay, so I got 9.35, but remember, how many did she earn? Remember, the maximum amount is 4 credits per year. Okay, so she earned, Maggie earned 4 credits. Okay, so let's do another example of this one, everybody. These are just kind of doing more review from the quiz. So remember, the formula's changed, so we're using 90% of the first 680. This was in 2007. Okay, so 90% times 680. We get 612, okay? And then it's going to be 32% of her earnings between 680 and 4,100, okay? Her average monthly benefit was, average monthly highest paying year was 3,776, so we're going to use that. Remember, we have to use the balance, so it's going to be 3,766 minus the 680. Remember, this is the balance part. This is A, B, C. So make sure that you do where you subtract the balance. Many people forget to do that. So we get 887 and 52 cents, and then we're going to add that. Okay, so we're going to add that together for C. So I will write it over here. So 612 plus the $987.52. So we add those two together, we get $1,599.52. Okay, this is talking a little bit about like 401k. So he makes $90,000. His employer contributes at 75 cents for each dollar up to 8% of his salary. If he contributes $350 from each biweekly paycheck, what's the total combined of his contributions and his employers? So 350. Remember, biweekly everybody is 26. So we're first going to find out how much he's going to contribute. So 350 times 26. Okay. So I get 9,008. Okay. So 90%, 90,000, sorry, times 8%. I'm going to find out how much that is, remember, because that's the maximum amount his employer is going to pay. So 90,000 times 8% gives us 7,020. Okay. So we're going to go ahead and add those two together, and that'll be the total. And the reason for that, everybody, is because he contributed more than 8%. Remember, his employer's only going to contribute up to 8%. Okay. So up to 8%. So 16,300 would be what his employer is going to pay. Okay, so we're going to go ahead and go over this one. Again, this is more review from the quiz, but people, so she's, Juanita is going to retire early. Her full benefit is $2,128. She's going to retire when she's 65, so it's a 9.2 reduction. So we're going to do, we're going to have the full amount, so the 2,128 minus the reduction. Okay, so 0.092. Okay, everybody, that's going to give us how much it's reduced by. So it's going to be reduced to $1,932.22. Okay, that's what her new benefit amount would be. Okay, I'm gonna go ahead and let you work on the worksheet, this tax form, and I'm gonna flip over to number 7 because I want to make sure we get to talking about insurance. Okay, so Reliable Insurance offers term life insurance policy with annual renewal premium. The first year is $795. Premiums increase by 4.1% each year. So just basically meaning that it's gonna go up for each year, um, so it's gonna be this. So it's gonna be a premium, the original premium amount times the percent as a decimal. And then it says for nth year, so how many ever years that you have the premium for. So that would be our formula, but we can go ahead and multiply the premium. So 795 times 0.041. So I got $32.60 times n, and n would just be the number of years. Okay, I'm going to go ahead and skip to number 9 because I want to get to the part talking about mortality rates. Okay, so remember with this, we're going to multiply. So it says, read carefully. So 63-year-old males, how many are expected to die before their 64th birthday? Round to the nearest integer. So we're going to multiply. It says males, so make sure we look at the right column. So this is males. 63, so we're going to multiply 10,000 times 0.01432. So we multiply those two together. Okay, and it says round to the nearest integer, so I'm going to round it to 153. Okay, it says based on that, what is the probability that they will live? So we're going to subtract it from 100, so 1 minus 0.015312. So I subtract it from 100. Okay, and I get 0.98468. If I wanted to change it to a percent, everybody, of course, we could multiply it by 100. And so we'd get 98.4688% chance that they will live till their 64th birthday. Okay, let's look on the other side. Okay, so Lieberman Insurance Company, they sell a 5-year term with a face value of $250,000 to a 39-year-old man for an annual premium. So the annual premium is $973. The mortality rate is given below. What's for each year of the death? Okay. So that would be doing that to find their expected profit. I'm going to tell you this one to refer to your notes. This could be a very long review. Okay, so I'm going to skip to number 12. Okay, so she is 62 years old. She retires in 3 years. She had $3,000 in savings. That will yield 2.25% interest compounded daily. She calculated her finally working salary to be $94,000. She's been told by her financial advisor she should have 65% of her annual income available for each year. What's the income that she feels? So 65% times the 94,000. So 64 4%, 5% is a decimal, times 94,000, so we substitute it in. Okay, so she should have $61,100 using the compound formula. How much will she have? And we want to know, so you would just multiply it for each time. Okay, and it's going to be compounded monthly. So we would be using our balance formula. So she has 300,000 plus, remember as a decimal, so 0.0225 is the rate. Okay, it's compounded daily, 365 days in a year, and it's going to be 365 times, if I go with 63, right, that's going to be 1 year. Okay, so that would be 1 minus 1 sorry, I forgot to put the 1 here. I'm going to have to put the K over here. All over. So 0.0225 over 360. Okay. And this would be for 63. And then we continue that. So then for 64, right, this would be 2 years. 65, that would be 3 years. Okay, so you keep doing that. So let's write it out again because I feel like I didn't write that one out well. So 300,000 times parenthesis 1 plus 0.0225 over 365 days in a year. 365 times 2 minus 1. Remember the double parentheses, all over 0.0225 over 365. Okay, that would be for 64. And then we do the same thing for 65. Instead of 3, though, we would put instead of 2, sorry, we'd put 3. Okay, so that's how you're going to do that one. Okay, so this one, planning to use 60% of her current salary in her first 5 years. What should the amount be? So 60% times 94,000. Okay, and it said for the first 5 years, so we're going to multiply that by 5. First 5 years, so it said what should that annual amount be? So actually we don't need the 5 years, we're just going to multiply it by 60. So we get 56,400. That's how much she would need. Okay, so her retirement account, everybody, so that's what you're going to look. If I just start, so you could do it using the amounts from 63, 64, and 65. But if I use just the amount from when she's 62, right, she had 300,000, and divide that by 20,000. So I'm just doing it when the amount that she has right now, not based on interest. Okay, I would get 15 years. So that is without adding on any interest at all. Okay. Okay, for this one, okay, so this one's doing a deposit formula. Okay, so we're gonna have, the deposit is going to be 100, well, he wants to have 100 million. So maybe that's 6 zeros times, okay, it's 4.2%, 0.42. Okay, and it's an annual yield, so it's gonna be over 1. All over, double parentheses, 1 plus 0.042, so the rate is a decimal divided by 1 because it's an annual yield, and then 1 times 13, he plans to retire in 13 years minus 1. So the amount that we would get everybody would be $59,390.48. This is round to the nearest 10,000, so we would round that up to, so 60,000. So we get 60,000. Okay. So how much does he deposit each year? He'd have to deposit 60,000. Okay. That's how much Mitch would have to retire. Okay, so this one is asking for her career average salary. So we're okay. So it's asking us what was her career average and what was her annual pension under that plan. So with this one, we would have to add them all together, and then use that amount. So we're just going to add all of these together. Okay, and then, so this is the first 5 years, so this is going to be 5 plus, and this is 1, 2, 3, 4, 5, 6, 7, 8. 8 times 2 is 16. So we're looking at the last, so for 21 years, everybody, so it's going to be the sum. So the 26,745 plus all of these that we're adding in. So all these, everybody, dot, dot, dot. And we're just going to keep adding all these together, and then we'll divide them by 21. Okay. So we're just going to keep adding all of these together. We got this. Okay, so we did all that, everybody, and I got 27,300. $68.81. Okay. So by the number of years that exceed 10, Okay, so we're gonna do the average, so the average career average salary that we just got, all our work that we just did, times 21, times the multiplier that they gave us, so 5.08% as a decimal, so 0.0508. Okay. Okay, so we get 29,197.05. Okay, what percent of our final average salary will retirement salary be? So we're gonna subtract it. So this is her final salary is 39,500. So we're finding the difference minus her pension amount that we just found. Okay, and that's going to give us the percent. Apologize for not moving it up so y'all can see this. And please, of course, as always, double check my work on this. There's a lot of numbers to add together. So we multiply it by 100 because it's asking us for the percent. So it would be 26% decrease if we subtracted that from 100. Okay, that would be, so it would be 74% of her final salary because this is a percent decrease. Okay, so this one, everybody. So we're looking at our review. Okay, pre-tax dollars. Her income was 72,000, and she files as a single taxpayer. What should her taxable been? Had she contributed to count in after-tax dollars, and use the tax tables. Okay, so we're going to use that it was, she's going per month. We're going to use the tax rate of 24%. Okay, and so 24, so 300 times 12. So she contributed 3,600. So let's go ahead and figure this out. So if she did 72,000, okay, and we want to know how much she contributed in after tax. So that would be after. So let's go ahead and, so that would just mean that we would just multiply it and not include she deducted any money. So on B, it's asking us if she did contribute that amount, the $3,600, and used it pre-tax. Okay, so meaning that it would be tax exempt. So we're just figuring out both amounts. So if she did it after tax, her taxes would be $17,280. And then if she did it after, okay, now she's only paid $16,416. It said how much did she save in taxes? So we're going to go ahead and subtract 17,280 minus the 16,416 because we want to know how much she saved. We all like saving money. Okay, so she saved $874 and also contributed to her tax. Okay, I'm going to go ahead and skip number 16. Not to say it's not valuable, but I want to make sure I get to some of our problems with COLA. Okay, so let's look at this one. So they have a flat rate pension, okay, with a premium amount of dollars. She's worked for Circuit Technologies, okay, for 23 years. Jane has decided to change careers and leave her current work. She's told there'll be a 2.5% cost of living adjustment. Okay, so 23 years, so that means she's going to get $57. So 57 times 23. Okay, that's just going to give us her. Yeah. And so it just would be. This is just to figure out her pension. So it would be $1,311. Okay, so that would be her determine her monthly pension. And then we said we're going to do COLA. So remember that's where we add the 100%, okay, plus the 2 and 5%. So I'm going to put that over here. So that would be 1.0205. So remember we add those two together. We're going to multiply those. Okay, so now her pension due to cost of living increase is now $1,337.88. Okay, let me make sure I'm explaining this one right. So this would be 100 plus 2.5%. Okay, so we get 102.05%. Okay, and that would be, oh, you can see that. So that would be the cost of living increase. Okay, right? So this is COLA. Yep, we're not talking about Coca-Cola. Okay, so let's go ahead and do this one, another career average one. So we're going to do career average, but we're going to do the final. I wanted to make sure that we're doing one with final, and we're just going to use the last 3 years. Okay, so we're going to use the last 3. So we're going to use that one. What was the final 3? So we're going to add those two together. So 62,000 for Petra. So we got 62,000 plus 63,000 plus 63,500. Remember, we're going to add all those together and divide by 3. So 62,000. Make sure to count the zeros, everybody. And we're pretty good at that by now. Make sure also to put the parenthesis sign, and then we're going to divide by 3. So I got $62,833.33. I love those 3s. Okay, so what's his annual pension? So remember that's going to be the final average, so 62,833 times the number of years that you work for the company. Okay, so we worked there for 16 years, so 16 times the percent multiplier. The percent multiplier is right here. So I'm going to do 0.0246. And we multiply those all together. Okay, and I got $24,731, and we would round that to 20 cents. Okay. Okay, so I'm gonna leave it that one and skip the last two so we can get to the back. Okay, so this one, okay, oh, this is perfect. This is just like what I was trying to do with the last one, everybody. So it's going to be their final average. Okay, so we're going to add all those together for Mike, and we divide by 3. Okay, and so we get that first, and it says 25. So times 25 years times the percent multiplier, so 0.01474. So just so you know, you can actually do those all together like that. Just make sure you do parentheses around the salaries that we're adding together. Double check the numbers too. We got this, everybody. Okay. So I got, so his annual pension would be $37,140.83. Okay, so that would be his annual. If I needed to find monthly, remember, everybody, I would just divide it by 12. So then I would get 3,000. So remember, this is annual. This would be monthly. So monthly would be $3,095.07. So that would be monthly. Okay. So just be careful on the problems. Double check if it's saying annual or monthly. Okay. So same with this one. Everybody add them together. We're going to divide by 3. Okay. He worked there for 27 years. They both worked for the same company, so it's the same multiplier, so 0.175. So I'm using the same multiplier, so go ahead and put that in the calculator. Okay, so for the annual pension, Rob will receive $35,122.50. Again, if I want to find monthly, I'm just going to divide all that by 12. So he would get $2,926.88. So that would be for monthly. Okay, remember this is annual. Okay, this problem is on vesting. I'm going to go ahead and skip that one. Okay, but we did the review. Good job.